Everyone's talking about the next market crash but here's the truth. It's not a matter of if, it's a matter of when. Every few years the market hits that breaking point. Stocks fall, fear rises, headlines scream disaster, and most people panic. But the smartest investors? They're quietly buying. They know these moments build wealth for the next decade. In this video, I'm going to show you 3 powerful ETFs that have historically thrived when everything else falls apart. These aren't risky bets or quick flips. These are long-term wealth-building opportunities that have proven themselves through every major crash. So if you've been waiting for a chance to turn fear into fortune, stay with me till the end. Because once the market tumbles, these 3 ETFs could be your ticket to getting rich while everyone else runs for cover. Imagine this. The market's bleeding red. Your favorite stocks, the ones you thought would never fall, are down 30, 40, even 50%. The news cycle is non-stop panic. Recession fears. Interest rates rising. Inflation's back. Everyone's rushing to sell before the next drop hits. And just like that, years of gains vanish in days. Your portfolio shrinks, your confidence shakes, and the only question left in your head is, where can I put my money where it won't disappear overnight? This is the moment when true investors separate from the crowd. Because while everyone else is drowning in fear, the quiet few, the ones who've studied history, already know where to turn. They've seen this movie before, and every single time, one asset has risen from the chaos like a steady heartbeat, calm, constant, untouched by panic. That asset is gold. Now, I'm not talking about chasing hype or crypto-style volatility. I'm talking about the one thing that's outlasted every financial storm for centuries. Gold doesn't care about who's president, it doesn't care what the Fed says, and it definitely doesn't crash because of some trending headline. When fear rises, gold shines. It always has. Let's rewind the clock. In 2008, when the housing market fell apart, major banks collapsed, and the stock market lost over 35%. Gold quietly rose about 5%. It didn't just hold steady, it grew stronger while everything else was breaking. Then came 2020, lockdowns, panic, and markets collapsing nearly 30% in weeks. Gold? It climbed over 25% by the end of the year. And even today, in 2025, while the economy feels calm on the surface, gold prices are still surging. Inflation has cooled. Recession hasn't even hit yet. And still, investors are piling in. Why? Because deep down, everyone senses something's off. You see, gold isn't just a shiny rock. It's trust. It's the asset the world runs to when the system feels shaky, when the dollar feels heavy, when debt feels endless, when markets feel fragile. Gold becomes the safe place again and again. Now, here's the smart way to play it. You don't need to buy bars of gold or lock coins in a vault. You can get exposure through gold ETFs, funds that track the price of gold almost exactly. 2 of the most popular are GLD and IAU. GLD moves almost 1-for-1 with gold prices and is easy to buy through any brokerage app. IAU does the same but with lower fees. Perfect for long-term investors who want that stability in their portfolio. Think of gold as your insurance policy, not to make you rich overnight, but to protect your wealth when everyone else is losing theirs. Because in every major crash, 2000, 2008, 2020, gold either stayed solid or moved up while stocks burned down. And those who had gold ETFs weren't scrambling to sell. They were watching their portfolios stay alive while the rest of the market melted. That's the secret. Wealth isn't built in bull markets. It's protected in bear markets. And gold has proven, again and again, that when fear hits the economy, it becomes the silent winner. So when the next wave of red hits the screen, and it will, ask yourself one thing. Are you ready to panic, or are you already protected? When markets fall, most investors do one of 2 things. They panic, or they freeze. But the seasoned ones, the ones who've been through crashes before, they move differently. They don't chase the storm. They brace for it. And when the world starts selling, they quietly start shifting their money toward safety. Because here's a truth that never changes. In every market meltdown, there's always one corner of the financial world that actually rises while everything else falls. And that corner is U.S. Treasuries. Yeah, I know. It doesn't sound exciting. It's not some flashy stock or hyped-up trend. But when panic hits Wall Street, Treasuries become the heartbeat of calm. Let's paint that picture. It's 2008. The stock market's crashing faster than anyone can process. The S&P 500 loses a third of its value in months. People's retirement accounts are bleeding. And while chaos spreads, long-term U.S. Treasury ETFs, like TLT, soar nearly 28%. Fast forward to 2020, the pandemic crash. Markets drop 30% in weeks. And again, investors flee to safety. TLT jumps around 18%, protecting portfolios that would have been destroyed otherwise. It's not luck, it's psychology. When fear takes over, investors don't care about returns. They care about survival. And the one place the entire world still trusts for survival is the U.S. government's debt. Because here's the simple logic. No matter what happens, America always pays its bills. It might print more money, raise more debt, or argue in Congress for weeks, but it pays. And that consistency is gold for investors when everything else is falling apart. Now, let's talk about how to actually use this in your favor. You don't need to buy government bonds directly or wait months for payouts. You can invest through Treasury bond ETFs, which trade just like regular stocks. Two of the strongest names are TLT, which tracks long-term 20-year treasuries, IEF, which focuses on 7 to 10-year treasuries. Here's how it works. When markets crash, investors rush into these funds, driving their prices up. And while everyone else is panicking, your portfolio suddenly looks calm, balanced, even profitable. It's like having a financial parachute strapped on before the turbulence begins. You don't hope for a crash, but if it happens, you're not falling, you're gliding. Even today in 2025, with debt talks, inflation worries, and political noise everywhere, Treasuries still remain the world's flight to safety. Because no matter how messy things look on TV, global investors, from Asia to Europe to New York, still trust the U.S. Treasury market as the ultimate safe zone. That's why professionals, hedge funds, pension managers, even billion-dollar institutions keep a slice of their portfolios parked in treasuries. It's not about profit. It's about protection. Because the fastest way to build wealth is first to stop losing it. So when the next correction hits, when your phone lights up with market in free fall alerts, remember this. While most people are panicking, the prepared few are collecting steady gains, one bond ETF at a time, and that's the power of playing defense. Before the crash even begins. Every crash has two sides. On one side, chaos, fear, screens glowing red. On the other, opportunity, quiet strength, and investors who knew how to stand their ground. And that's where defensive stocks come in. The kind of companies that don't just survive tough times, they thrive in them. You see, when the economy slows down, people stop buying new cars, luxury gadgets, or designer clothes. But they never stop buying toothpaste, groceries, medicine, and electricity. That's why defensive sectors, things like consumer staples, utilities, and healthcare, are the backbone of resilience. They sell what people need, not what they want. And that's what keeps their revenue stable when everything else collapses. Let's look at history again. During the 2008 crash, while the S&P 500 tanked nearly 38%, the Consumer Staples ETF, XLP, fell just around 15% and bounced back twice as fast. In 2020, when the pandemic froze the world, the Healthcare ETF, XLV, dropped briefly, then roared back within months, hitting record highs before the year even ended. That's not luck. That's strategy. Because defensive stocks are the steady heartbeat of any long-term portfolio. They don't always make headlines, but they build wealth quietly, through dividends. And that's the next big key most investors overlook. Dividends are more than quarterly payouts. They're proof of consistency. When a company keeps paying you during the worst times, that's a signal of strength. Imagine this. While the market is crashing, your portfolio is still sending you income every quarter, Cash flow that keeps coming in whether prices go up or down. That's not just stability. That's financial freedom. And the easiest way to tap into that power? Dividend ETFs. Two powerful ones stand out. SCHD focuses on companies that increase their dividends year after year. SCHD, known for high-quality, high-yield dividend stocks that have stood the test of time. Both give you exposure to some of the most reliable names in America, from household brands to utility giants, companies that don't just promise growth, they prove it. Now here's the beauty of combining all three strategies. Gold protects your wealth when currencies fall. Treasuries stabilize your portfolio when markets panic. Defensive Dividend ETFs give you income and steady growth no matter what happens next. Together, they create balance, the kind of balance that turns volatility into opportunity. That's how smart investors play the long game. So the next time you hear someone say the market's crashing, you'll just smile because you've already built your shield. This isn't about luck. It's about positioning. Because wealth isn't made by reacting to fear. It's made by preparing for it. Every generation faces its own financial storm. Some see it coming, most don't. And when that storm hits, when markets shake, headlines scream, and everyone's scrambling for answers, the truth becomes painfully clear. It's not timing the market that makes you rich. It's being ready before it moves. Because the reality is, no one can predict the exact day a crash begins. But every crash leaves clues. Whispers in gold prices, movements in bond yields, shifts in defensive sectors. And those clues are talking right now. We've already seen what happens when fear takes over, from 2008 to 2020 to the uncertainty building again today. History may not repeat itself perfectly, but it always rhymes. So don't wait for the next headline to scare you into action. Start positioning yourself before the panic. Because the investors who stay calm, informed, and diversified are the ones who walk away stronger when everyone else is counting losses. Keep a slice of your portfolio in gold ETFs, your hedge against uncertainty. Hold Treasury ETFs, your stability when markets fall apart. And build your base with defensive dividend ETFs, your steady income stream that grows quietly, even through chaos. This isn't about fear. It's about freedom. Freedom from panic. Freedom from financial stress. Freedom to make moves with confidence when the world hesitates. Because wealth doesn't come to those who react to noise. It comes to those who listen, prepare, and act with intention.